Good afternoon, everyone, and a very warm welcome to you all. Firstly, please accept our apologies for our late start today. We had a few issues there, but we've got everything back on track. Everything should be working okay. If you do have a problem, though, do send us a message and we'll try to address that. But so sorry again for starting 10 minutes late today. Thanks, though, for joining us, everyone, on our forecasting webinar. My name is Carol Flockert and I'm a partner at Chiene and Tait, and I'm joined by Alan Clark.
Hi.
Now, Alan is going to talk us through most of the presentation today, and Alan is a senior manager in our business support department. Now, this is the final webinar in our current series, and we had asked when we sent out the invites, we'd asked if this was the right time to give your organisation a business MOT. So over our series so far, we've been reviewing a number of areas aimed at giving your organisation a health check. So far, we've covered cash flow management, we've looked at the importance of business plans, and we've also looked at various aspects of RTI and pensions auto-enrolment from a payroll perspective. Today, though, it's all about financial forecasting. This is the last in our current series of webinars, but later in the year we are planning to run a separate series, and we're going to include topics such as VAT return preparation tips. We're going to look at company secretarial matters and also auto-enrolment. If you have any ideas for other topics, please do let us know. If you've missed any of the webinars that we've done so far, you can also access recorded versions through our website. So today we're actually planning to present to you for about 35 to 40 minutes, as we've got quite a lot of material to cover today, and then we'll hopefully still have time for questions at the end. Because of our late start, we're hoping to finish things then by about 1:25, and hopefully you'll all be able to stay logged in for that late finish. Moving on to then a couple of housekeeping points, and we'll look at how to ask a question. Some of you will be familiar with this from our previous webinars, but I know a few logged on today are new to our sessions. If you have a question that you would like to ask us, please enter that in the dialog box that you can see on your screen. And on the slide there is a picture of what that dialog box looks like. We will take questions at the end, but please do let us know your questions as we go through, and then we'll cover them at the end of the session. If you can't hear us clearly, please let us know through that dialog box and we'll do our best to address that. You can also get in touch with us by pressing on that figure image at the top of the screen with their arm raised, and through that box you can indicate if you want us to speak more slowly or to speak more loudly, for example. If you're still having any sort of issue with your IT connection or sound, please do get in touch with your IT support. We're also recording our session today, and that will be available for you all to download through our website. After the session, we're also going to send you a copy of our slides and some additional information about forecasting. Because there's quite a lot of material that Alan's going to cover, we will send you out some of this information afterwards as well. I'd now then like to just briefly introduce Alan and myself. Those of you who have listened to our webinars before will know that I'm a partner with Chiene and Tait, and I've been with the firm for 19 years. I look after the business support department, which provides an outsourcing finance function to clients. And what we're doing is often acting as finance controller or finance director for businesses that don't have that function in-house. So as well as things like management accounts and VAT returns, we also help with financial forecasts as well as business plans. Alan is part of our senior management team and has worked with the firm for 8 years. Alan has a broad range of clients whom he provides a full finance support function to. Alan has got extensive experience in all areas of financial support, and especially in the area of financial forecasts. On that note then, I'll just now hand you over to Alan, who will take you through today's presentation. And he'll start us off by just talking through the topics that he plans to cover today.
Okay, let's get started. Sorry for the delay, unavoidable IT issues. We've got lots to cover today, and I'll put my hands up at the start. Some of this is complex and may be tricky to follow, but remember I'll be taking questions and would be happy to have one-to-one discussions for any queries you may have. So the aim of today is to give you a brief introduction to and understanding of financial forecasts. To do this, I'll firstly introduce forecasts, talk about why you need them, and cover the basic structure and content. I'll then spend a bit of time showing you two possibilities for preparing forecasts, being Microsoft Excel and a specialist piece of software, Sage 50 Financial Forecasting. I'll then switch back to discussing testing and stressing your forecasts, including giving you some tips. And finally, I'll finish up taking any questions and give you an action plan on what steps to take next. A general definition from Wikipedia says that forecasting is the process of making statements about events whose actual outcomes have not yet been observed. In other words, it's about looking forward. So what do we mean by financial forecasts? A working definition could be an estimate of future financial outcomes for a company. Financial forecasts are a best guess of what will happen to a company in financial terms over a given time period. In many cases, the title projections or budgets are also used to describe the same thing. To me, a set of financial forecasts includes a projected profit and loss account, or the profitability of the company, and will include non-cash items such as depreciation, a projected balance sheet, the assets and liabilities of the company as at a set date, this being the last day of the month, the year, the quarter, etc. A projected cash flow, the physical payments and receipts on a periodic basis, including both profit and loss and balance sheet transactions. And finally, a set of assumptions. This is critical to the outside reader's understanding of the forecasts. For example, the days you will take to pay your creditors or to receive cash from your customers. I've talked about what forecasts are, but why do we need them? Forecasts can be prepared for many reasons, which can be split into three general groupings. And remember, you may be preparing your forecast for multiple reasons from the different groups shown on the slide. First and foremost, projections can be prepared for monitoring purposes, be it for strategic planning or to feed into your business plan. This could then highlight the need for funding, in which case the forecasts would also be used to provide to a third party, typically banks for debt finance or equity finance from investors. In the current climate where optimism in business is improving, many entities will be considering how to grow their business. Planning for growth will necessitate the preparation of projections, be it for investment in equipment or expansion into new products or areas. It's essential to look at such things in advance to give you time to prepare for the most appropriate credit facility if required. All too often we speak to businesses who find themselves in trouble because they haven't planned properly.
Before we move on to the next slide, I think it's just important at this point to emphasise the importance of projections, because they really are an integral part of running your business. As Alan has said there, they can help you plan your business growth and anticipate cash flow issues. In the last few weeks, I saw an interesting article from the Real Business website, and if you've not come across that website before, please do have a look. There's really some quite interesting pieces on there. The article in question, though, stated that research has shown that thousands of entrepreneurs are resorting to credit cards and personal financing to fund their business. And according to this article, and according to lender redbuildingsociety.com, actually around 300,000 SME owners will use personal credit cards to raise cash in 2014. 150,000 owners will borrow from friends or family, and actually 50,000 will remortgage properties to raise finance. I think if you're properly forecasting in your business, you may find that actually you can better plan in advance for your funding, so you may not need to go down any of these routes. They might be fine in the short term, but you'll want to think about your long-term funding. So if you've got forecasting that you're looking at on a regular basis, you may not need to resort to strategies such as remortgaging properties.
Okay, look, that's a good point. Let's look at the content of projections now. Projections must have credibility. We've seen many sets of projections showing £1 million profit in year 1 with world domination in year 5. Equally, we have seen 5-year projections which never show a profit or positive cash flow. Overly optimistic or pessimistic projections do no one any favours. Your projections should be challenging but achievable and seem reasonable on review. You need to consider your audience. Never go to the bank with a set of forecasts that do not demonstrate a need for financing or equally an ability to repay a loan. So if your forecasts peak at a £48,000 overdrawn account, make sure you apply for a £50,000 overdraft. Reality will never pan out exactly as you have projected, so don't get hung up on details where the actuals will be in a tight range, for example your office expenses. Forecasts are typically run on a monthly basis for 3 to 5 years, but can be on an annual, quarterly or weekly basis and could cover a 6-month to 35-year period. The frequency and length of period will have a direct impact on the level of detail required.
Yeah, that's a good point that Alan's making about duration. We often get asked how long should you forecast for, and there really is no right answer to that. You will quite often see 3 years as a period, but in some instances you may need to forecast out longer than that. I prepared a set of forecasts recently for a hydro project, and they in fact were projecting for 20 years, and that's what was most appropriate for that project. If you're looking for funding, you might actually ask the bank what period they're looking for, rather than you preparing 10 years, they're only interested in 3. So it's a subjective area, there's no right answer, but it's more about what's most
The number of income and expense categories may differ. If you are micromanaging cash flow, a lot of detail may be required, whilst a 25-year loan may need a lot less. It may be that the detail is all there but collapsed into fewer headings for reporting purposes. This is easy to do using forecasting software. Although I have said you can generalise in some cost headings, you may want to focus in great detail on the key drivers of the business, for example turnover and critical costs. In some cases, it may be an advantage to set up some calculations in Excel and then link to your forecasting software or projection spreadsheet. Another deal breaker with the credibility of a set of projections is to ignore tax, something that many people do for simplicity. Whilst making a set of projections, especially in Excel, more complicated, the figures do not have any credibility unless such things as VAT, corporation tax, or PAYE and national insurance have been allowed for. As noted earlier, there's no need to make it any more complex than it already is. Just use the same rates throughout and note this clearly in your assumptions. Ensure payment profiles for all taxes meet with the standard terms offered. It does not look good to ask a bank for funding using projections which include a stressed business payment plan for corporate. We have been approached by one client whose business is labour intensive with a view to looking at the projected costs, both direct, the employer's contribution, and indirect, the additional compliance costs.
Yes, just on that pensions auto-enrolment point, some of you will have been on our webinar at the end of February, and you'll know that Neil and I spoke briefly in that about pensions auto-enrolment. And you'll know then that when you first stage an auto-enrolment, your employer contribution is 1%, but that does scale up to 4%. We do have information on those rates on our website, so please follow the link that we'll give you afterwards and you'll be able to find out those rates. But don't forget to forecast for pension costs.
Finally, no one likes paying tax, but remember, it's encouraging. It means you're making profits. So let's have a think about key considerations in projections. What are the key figures? You need to concentrate on them and model them accurately. In any set of forecasts, There are going to be key areas, one of which will always be sales. Consider multiple categories covering, for example, different areas, products, sales personnel, etc. Then flowing from this, your key costs, it could be staff costs, materials or fuel, it just depends on your business. Now, on the next few slides, I've drafted up a simple profit and loss account to show you an important concept in preparing projections, which is linking data. So in this example, you can see that salaries have been linked to sales as a percentage. For example, the English salaries are 50% of the English sales figure. If we move on and look at scenario 2, now, you'll see that expansion into England is proving to be successful. So we've entered sales for England of 1,000, and by doing this, salaries for England.
Oh, sorry, we're just getting moving ahead of ourselves there.
Salaries for England have automatically been increased to 500. Not a big difference in this case, but remember, imagine scaling it up and changing for every month in multiple scenarios. It's a big time saving if one figure is automatically derived from the other. And more importantly, the automation stops you having to worry about updating all these costs manually.
Yeah, that's a good point, because actually on one of my nursing home clients, we do something similar. What's very important to them is salaries as a percentage of turnover. So in the forecasts, exactly as Alan is saying, we link the salary line to the income line, and that means that actually it cuts down on your manual entry. So it is it's quite an important one.
Yeah. Finally, remember that in a final version, this detail can be hidden if required, but for key areas, building this level of complexity into the projections is advantageous. So, as well as the key considerations, there are obviously other things to consider as well, one of which would be depreciation rates. This should of course be in line with any accounting policies already used in your accounts, or if it's a new venture, matching it to the useful life of the asset. Debtor and creditor days will also have to be taken into account. This is the number of days your customers take to pay you, or you take to pay your suppliers. In some projections, stock may be incidental, in which case it can be assumed to be constant throughout the year. In others it may be critical, in which case some more detail behind the projections will be required. Prepayments and accruals should be included, but only where significant. For example, if his rent is prepaid for a full year, then you would reflect that in your projections. Loans and HP payments also need to be taken into account, either entering the known split between interest and capital or using the software to calculate it. Finally, interest on projected overdrawn balances needs to be taken into account, and you may want to assume interest is paid on any credit balances. However, at present, with interest rates where they are, I would not consider this to be worth it. So if you don't have forecasts at the moment, you need to think about how you're going to set them up. And the first decision is, do you use Excel or a dedicated software package? Excel has the advantage that anyone can start off with this. However, there is a large potential to build errors into the projections as time goes on. Everyone knows the way we overtype formula at the 11th hour to make something work. Imagine how many such fixes could be incorporated into a 25-year set of forecasts. The alternative is to use a projection-specific software product. These offer the primary advantage that they are difficult to break and have built-in flexibility. However, they do rely upon the quality of the inputs and require more setup time. We can now have a look at examples of each, so bear with me while I switch over to Excel.
Yeah, Alan's now going to take us into an Excel set of forecasts, just to have a brief look at that, and then we will hopefully then move on to Sage 50 forecasting, just to give you an idea of a couple of different ways that you could be doing your forecasts. Because I know many of you listening will probably use Excel, but you might want to actually think.
Okay, give it a sec.
Okay, we had a little little issue there. We're hopefully now back on track and are just going to be opening up. There we go. That's hopefully you'll see now our Excel forecast, and Alan's just going to say a couple of words about that.
I don't know how many times I've practiced this and it's worked fine every time in practice, but not today. Never mind. Hopefully you can now see Excel in front of you, and for those of you, if there's any problems, there were screenshots on the website as well that you could download. The screenshots for Excel are all just named in line with the tabs on the spreadsheet. So just going through them, we have a profit and loss tab where you can see the monthly figures for turnover, cost of sales and overheads, and towards the bottom you can see the profits before and after tax. We have a cash flows tab which shows the income and expenditure together with the monthly inflow or outflow, and then the opening and closing balances. We have a balance sheet with the fixed assets, current assets, etc., etc. And as we've mentioned before, you need to have a set of assumptions. This is a very basic spreadsheet, so it's quite a short list of assumptions, but they're there as well. The fifth tab or PDF file that you'll have is the input sheets. This is a scary looking sheet, but this is the key document for setting these projections up. And the idea is that you only enter figures in the yellow boxes, and all the other spreadsheets are populated from here. So just while we're in here, this is a good example to show you linking of data. If we look at purchases in England, you can see that this is being set as being 75% of cell F8, which is sales in England. So you can see that we've set purchases up to be 75% of the sales for that month. And you can see that this is repeated going across month by month. So all we have to do is change the sales figures, and the purchases will obviously be updated automatically. So that's 12 data entries that you don't have to worry about, and you can have peace of mind that it's all working okay. So all spreadsheets are set up in different ways, but you'll see in my assumptions that these projections are based on 0 days credit to customers and suppliers. Now this might be overly simplistic, but for this particular example it was fine. However, if we wanted to change that to say that customers and suppliers were paid us a month after, we would have to go back into this and move everything across a month, which is going to take quite a bit of work. And in addition to that, we would also have debtors and creditors at the end of each month. So there's a lot of programming work that would need to be done to get these updated. So typically when clients come across this is where they decide, no, it's time to move on and let's get some dedicated software to do this for us. So let's just switch over now to Sage 50 forecasting. Again, there are PDF files. There's a PDF file of this welcome page on the website, and there's one later on that I'll refer to as well. So straight away you can see that this is a dedicated piece of software. Along the bottom it's giving you a running indication of what your bank balance will be, what your gross profit is, what your net profit is, and these are all customizable in the software, so you can set it up as you want it. On the left hand side you'll see all the records lists, so each category that we've been talking about is called a record. So if we go into sales for this set of projections, there's one called Coach and Garage Sales, so we can go into that and see that it has tabs for sales where you can manually enter the sales that you want to show, or there are more choices than you could possibly need for how you set your sales into the system. You can link to Excel if you want to, all sorts of methods. The next tab shows receipts, and in this one this is set on a payment profile, so much is received within the first month, so much after 30 days and so much after 60 days. But again, there are all sorts of ways to set it, including you can see you can use days credit, which was the debtor days we were talking about earlier. The third tab, the last tab here, is debtors, but we don't have to enter anything here because all the information is derived from the first two tabs in this system. So closing that one down, I just want to show you another one. So indirect costs, so this petrol and oil record is the second PDF from the forecasting software that's on the website. You'll see here that in costs we have set the budget entry method to be as a percentage of sales. So we're saying that it's linked to coach and garage sales, and in this instance it's set as 22.05% of sales, a very exact figure. I'm not sure where that came from, but there you go. So I've not got much time to show you this software. You can hopefully get a glimpse of how important it is, but there's also, I will just want to show you the profit and loss account report here. You can see also the balance sheet and cash flow reports. But if we run a profit and loss report, you can see at this stage it's giving you the option to set how many years you want to run it for and from where. So let's just run that. This dumps all the information for the report into Excel. Just takes a couple of minutes to run, a couple of seconds hopefully. It is very customizable. You can get to show quarterly figures in amongst that as well. So here's an example of the information that it produces. We talked about being able to collapse headings, which you can have all the detail there, but you might want to just summarize information for some of your reports. So these bars at the side allow you just to collapse direct costs into one line, sales into one line, and overheads into one line. Now all of a sudden you've just got a summary headline information report, which may be quite useful in some of your reports. So bear with me, I'm just going to change back to the presentation.
So we're just moving back to our set of slides now. If Kerry has asked me just to remind you all, if you could use the minimize button, hopefully that makes sense to everyone. Well, now that Alan's finished the demos, so that you should hopefully now be able to see the slides again.
Okay. I'm just going to flick through the ones that we've covered now. So we've covered Sage 50 forecasting. So you've now got a set of forecasts that you're happy with.
Actually, sorry, I'm just going to interrupt Alan there completely. Just before we move off Sage 50 forecasting, just to say, if that was a very, very brief look in the time that we've got today at the product. If you might want another look at the product, if this is of interest to you, please do get in touch with us after the webinar. We're actually a Sage accredited partner here at Chiene and Tait, so we're able to purchase this software for you for a discount. We can also help you with getting the structure set up, because that's really a critical part in your forecasting using this sort of software. You have to get the structure right. So we can help with the structure, and we can also help with training and how to actually in and have a one-to-one more detailed demo with Alan. He would be happy to do that as well. The other thing that we're going to be doing is having a Sage Financial Forecasting training event in our office later in the year, and that's when we're going to actually go through the product in a bit more detail.
Okay, let's move on and look at what we do once we've prepared our projections. Once you've got draft projections, you need to stress test them. This is often referred to as what-if scenarios or sensitivity analysis. You need to know where the break-even point is. This is important. This is a point in your projections at which gross profit equals your overheads. You might be looking at this on a cash basis or on a profits basis. You'll also want to consider sensitivity analysis, and this will include looking at your key customers and thinking, what happens if a customer does not come on stream until a year after expected, or say it takes 60 days to pay you instead of 30. You can look at possible risks that affect the projections. For example, what happens if interest rates rise or inflation is higher than expected? A key risk to test is wage inflation. At the moment, this is below inflation, but there have been many years in which it's been significantly above. And finally, I'm going to go back to auto-enrolment. This represents a significant new risk for businesses. Although low just now, what happens if the government ramps up employer contributions in future years? Definitely something to consider. So once you have your projections, you've stress tested them, you think they're realistic, they're challenging but not unattainable, you need to move on to the next stages. This might be weaving your findings and headline messages into your business plan. Remember that your projections should drive and support what you're saying in your business plan. For example, you have a peak overdraft requirement of 250,000 and that this will be paid off within 3 years. When forming your business plan, it's standard practice to include the full projections, including the assumptions, as an appendix to the plan, referring to it throughout and drawing key figures from it as required. Projections can take a long time to prepare, and you may well feel frustrated that your masterpiece is relegated to an appendix. Another point to consider is a sense check or review of your projections or business plan. You need an honest third-party view, and as accountants, that's something we do frequently for clients. If you're using projections for monitoring, then you want to think about reporting against what is in effect now a budget. Alternatively, you can update your projections with actual figures, producing a rolling forecast. And I would avoid revising projections unless absolutely necessary. These are just an indication of what's to happen, so unless something significant happens, it shouldn't be necessary. So I said at the start I would give you some hints for preparing projections. As I've said, simplify where not relevant. A bank will not be interested in how much you intend to spend on office stationery, hire of a photocopier, postage, tea and coffee, cleaning, etc., etc. So combine them, unless it works out to be a large number. Remember though that these costs internally might be significant and political, and so consider setting up collapsible categories so that you are in a position to monitor them if you wish to do so. This will allow you to focus on the key figures. As I've mentioned before, this will start with sales and can have significant detail, much of which will also be referred to from your business plan, but will also include your key direct costs and salaries. Finally, you need a starting point. If you're starting from scratch, then the job is easy. There are no opening balances. If you're an already established business, you need an opening balance sheet, the state of the business at the start of the projections. Because you need a starting point, many cash flows start on the first day of the business's new year. There are also pitfalls in preparing projections. We've talked about the key drivers, and one of the potential pitfalls is the level of detail to include. If you're referring to a particular aspect of sales in your business plan, then that at least should be identifiable in your projections. It may also be that you have levels of detail below this in the forecasts too. Are your projections realistic? If your projections are pessimistic, a bank won't want to risk supporting a loan, or your sales manager will put his feet up and take the day off. If the plan is too optimistic, an equity investor may regard your figures as cloud cuckoo land, or an operations manager may be designed to never meeting his targets and therefore lose motivation. Don't forget all your costs. For example, bank arrangement fees and related legal costs if you're after bank borrowings. Always ask for estimates and don't guess. If you forecast your figures too high, the bank are likely to charge you that, and if you go too low, you'll lack credibility. Assumptions help demonstrate your thought process and provide the reader with the framework for the projections. Many people will prepare the numbers which they will know inside out, but which cannot be followed by the reader. They may be correct and prudent, but without the assumptions, it's impossible for the reader to make this judgment.
Before Alan moves on to his next slide, just to remind you again about the questions, we will have time for a few minutes of questions, so please do enter anything that you think of in the dialogue box.
Finally, to conclude, I'm sure now I've convinced you that everyone should have a set of forecasts, either for monitoring or for seeking a cash injection. In addition, you will have seen that just going through the process will teach you more about your business. For example, understanding the sensitivities of the business to various risk factors, or understanding your key drivers. And finally, I've shown you a simple Excel forecasting spreadsheet which can be created relatively simply, but also given you a glimpse of the potential of using a dedicated forecasting software product. Okay, now we're on to our question time. We've got a couple of questions that have come through, but there's, if you do think of any others, please do let us know. As we said before, we're also happy to take questions afterwards. First question, Alan, then, that I have got here is in terms of interest rates. Now, during the presentation, you mentioned interest rates, and somebody's asking what rates should they include in their projections for an overdraft or term loan that they are seeking from the bank? Yeah, it's a difficult question, that one, because the interest rate will vary for every company. The bank take a view on the risk involved and will set the interest on that basis. So to start with, you might want to consider asking your bank what they would likely charge you. You could look at previous borrowings that you'd had from the bank, or if you have a relationship with one bank, you could consider going to another high street bank and asking them what they would offer. And that'll give you an indication. It may not be exact, but it'll give you somewhere to start.
Yeah, good. Yeah, so no right or wrong answer on that, I'm afraid. Change of tack then, Alan, with the next question. Again, you touched on this during the session, but somebody's asking how often should they revisit their forecasts during the year?
Yeah, I would suggest that you don't really change your forecasts during the year unless you absolutely have to. If there are significant changes to your business, then obviously they're meaningless and you need to go back and revisit them. But remember, these were just an estimate when you started, so just because they're slightly out from that isn't a reason in itself to go back and change them all again.
Yeah, and as a follow-on question to that, the question about when do you actually go through that forecasting process, so when do you actually set your projections for the year? What's the best time to do that?
Again, you really want to have your projections in place for the start of the year, so that might involve looking at month 11 management accounts or third quarter management accounts, doing a few adjustments to get you up to the year end, so that when you hit the ground running on day one of your new year, you already have your projections in place.
Yeah, I mean, just to give you an example, one of my clients recently actually kept putting off pulling together their forecasts. They were very busy in their business, generating revenue. They hadn't got round to their forecast, and actually it was almost at the time of preparing the first quarter's management accounts for the new year, and they still didn't have their forecasts in place. They were in fact in the habit of spending quite a lot of time going through their income budget and making that really quite detailed. But actually what they should have been doing was, going, I don't have as much time this year, I'll put something in place roughly just to make sure that they actually had a forecast, because they were basically holding the business back by not getting some sort of forecast in place. So don't overthink your forecasts as well. The next thing actually is not a question from a listener today, but I think we probably should say a few more words on it, because Alan mentioned a point about wage increase assumptions and what you should include on your forecasts, because there have actually been the minimum wage rates were announced recently. Alan, do you want to say a few words about that?
Yeah, I think the minimum wages has gone up by about 3%, which relatively speaking isn't too bad for a business to take possibly. However, there is a lot of talk about the new living wage, which is significantly higher than the minimum wage. So any move towards this measure of wages would have a significant impact, especially on sectors where they have a high proportion of low-paid staff.
Yeah, we will also be shortly putting the new minimum wage rates on our website. I don't think they're on as yet, but we will put those on very, very soon. And those new rates are in place from October this year. Okay, I don't think we've got any other questions coming through so far. We've got a couple of more minutes still to cover various things, so if there's anything that comes to mind, do let us know. So we're just going to talk about our action plan very, very shortly. I like to use the word we. What I actually mean is Alan is going to cover the action plan. Before we move on to that, I just want to say thanks very much for joining us today. I do appreciate your understanding with our issues at the start, and we had a wee hiccup in the middle there, but we got through those, so hopefully you've still managed to follow our webinar today. What you've got on screen now is our web address, and if you come up with any more questions, please do send us an email or give us a call. After the webinar, you will receive a copy of our slides. We'll send you some other information on forecasting, because Alan has covered quite a lot of ground today, so we'll give you more information on what he's covered. We'll also send you a short feedback form asking for feedback on our session today, and it would be great if you could just spend a couple of minutes completing that, because it's always good to have your feedback. We will be scheduling webinars later in the year and we'll let you know those dates. If you would like to know more about Sage 50 forecasting or a quote for the price of the product, let us know. As we said earlier, we are a Sage accredited partner here at Chiene and Tait, so we can get discounts on the software. We would also be happy to have a free initial meeting with anyone listening to discuss forecasting or to give you a demonstration of the software. I also mentioned that we would be running Sage events later in the year, and one of those events will be on Sage forecasting. We will also send you details of that, and again, those are free events, so we normally run those over a lunchtime, quite informal, with a presentation and then a Q&A afterwards, and those events and the initial meetings are all free of charge. So I'm now going to hand you back over to Alan, who's going to leave you with a few final thoughts on forecasting.
Okay, so to think about an action plan going away from this webinar, first of all, I'd say just go ahead and do it. I think most people recognise that you need to have some forecasts and possibly a business plan as well in place. So the process is to identify how you're going to do this, what software are you going to use, think about the key drivers in your business, consider how you're going to structure your projections, and again, don't forget about taxes, a critical aspect. Test your projections using what-if scenarios and consider a third-party review. And then finally, think about how this feeds into other documents within the business, for example, your business plan.
Great, well, thanks very much everyone again for joining us and for your patience. I hope you all enjoy the rest of your day and we see you again soon. Thanks very much everyone.